For your listening pleasure today, Chapter 3 of the 5th edition of my book, Trend Following. Now, I am not exactly a fan of audiobooks. I guess I should be, since so many people I respect are into them. And I think this edition of my book, Trend Following, as an audiobook came out great. And again, I hope you enjoy it. However, I got to tell you, the written version of my 5th edition of Trend Following, 220,000 words. This is the type of book that you keep in the family. It's the type of book you're proud to have. It's the type of book that when you open it up, every damn line, in my humble opinion, is interesting trend following insight. And that particular experience of just opening up a book to any page, you can't do it with an audiobook. Again, I'm not trying to pick sides here. I'm just offering a perspective. But if you are an audiobook fan, I got to tell you, if you buy the 5th edition of Trend Following, the hardcover, I don't think you'll be disappointed. Without any further delay, let's jump right into today and get some learning done.
Chapter 3, Performance Proof. Even if you are a minority of one, the truth is the truth. Gandhi. What we've got here is a failure to communicate. Some men you just can't reach. So you get what we had here last week, which is the way he wants it. Cool Hand Luke. Anyone can tell you they have a successful method or system, but the only objective measurement is raw data. If a claim is to be made, it must be supported. The numbers in this volume, across numerous third-party reporting services and inside disclosures on file with American and international regulatory authorities, don't lie. You could be the skeptic and say, "Hold on, the numbers could be faked." That doesn't fly with decades of data across unrelated traders located in dozens of countries. This is not about one isolated Bernie Madoff track record open to hanky-panky. Thus, in reviewing legendary trend-following performance histories and assorted research studies I alone might own, my insider investigation methods are a whole other book, I zeroed in on 6 key data concepts: 1. Absolute returns, 2. Volatility, 3. Drawdowns, 4. Correlation, 5. Zero-sum, 6. Berkshire Hathaway. Absolute returns. An absolute return trading strategy means you are trying to make the most money possible. Author Alexander Anikin defines it succinctly. An absolute return manager is essentially an asset manager without a benchmark. Benchmarking can be viewed as a method of restricting investment managers so as to limit the potential for surprises, either positive or negative. Trend following in its purest form doesn't track or attempt to mimic any particular index, ever. If trend following had a coat of arms, absolute returns would be emblazoned upon it. It thrives and profits from the surprises benchmarking artificially stops. However, not all trend followers are shooting for absolute returns or the most amount of money possible. Not all play the game full tilt. Jerry Parker, for example, purposefully aims for lower returns to cater to a different client base, those who want less risk and less return. But John W. Henry long made the case that the overall objective is to provide absolute returns. Relative return managers, such as most traditional equity or fixed income managers, are measured on how they perform relative to some predetermined benchmark. We have no such investment benchmark, so its aim is to achieve returns in all market conditions and is thus considered an absolute return manager. Shoot for a benchmark in returns and you run with the crowd. Benchmarks such as the S&P might make you feel safe, even when that feeling is clearly artificial. Trend following, on the other hand, understands that trading for absolute returns and not from blind adherence to benchmarks is the best way to handle uncertainty. The concept of indexing and benchmarking is very useful in the EMT world of traditional, long-only, passive investing, but it has almost zero usefulness for an absolute return process. Again, it gets back to what it takes to achieve an absolute return. You need an enormous amount of latitude and freedom in executing a trading strategy to ensure capital preservation and achieve a positive return. At its core, the concept of absolute return investing is antithetical to benchmarking, which encourages traditional managers to have similarly structured portfolios and look at their performance on a relative basis. If you base your trading strategy on benchmark comparisons, it doesn't matter whether you are a talented trader or not, because all decisions are about the averages. Why is any trading skill relevant? It's not. That's why 80% of mutual funds don't beat averages. Volatility versus risk. There are organizations that rank and track monthly performance numbers. One organization gives a star ranking, like Morningstar. The quantitative rating system employed ranks and rates the performance of all commodity trading advisors, CTA. Ratings are given in 4 categories: A, equity; B, performance; C, risk exposure; and D, risk-adjusted returns. In each category, the highest possible rating is 5 stars and the lowest possible rating is 1 star. The actual statistics on which the percentiles are based as follows: 1, performance, rate of return; 2, risk, standard deviation; 3, risk-adjusted, Sharpe ratio; 4, equity, assets. Dunn Capital once received 1 star for risk, the implication being that an investment with Dunn is more risky. However, these rankings don't give accurate information on Dunn's true risk. This rating group uses standard deviation as their measure of risk. But this is a measure of volatility and not necessarily risk. High volatility alone does not necessarily mean higher risk. It's doubtful Dunn, with a track record exceeding 40 years, is overly concerned about being inaccurately penalized, but using standard deviation as a risk measurement does distort a true understanding. This same firm's ranking of then-active trader Victor Niederhofer demonstrates the star system's weakness. At the time of Niederhofer's public trading demise in 1997, he was rated as 4 stars for risk. Based on Niederhofer's past performance, the rankings were saying he was a much safer bet than Dunn. Obviously, the star system failed for people who believed Niederhofer was less risky. Standard deviation as a risk measure does trend following an injustice. One of my goals is to dispel the simplistic notion trend following is risky, or that all trend following strategies have high standard deviations, which means they are bad. A good illustration begins with this 10-year chart of various trend following performances. See Table 3.1a and b in the supplemental PDF. Just saying a trader is volatile and thus bad makes little sense if you examine absolute return performance. Table 3.1. Raw absolute returns should count for something far more than fear or career risk. They equal the only way to massive wealth. Nonetheless, volatility, what standard deviation measures, is still a pejorative for most market participants. Volatility scares them. Even when a young student can quickly analyze any historical data series to see volatility is normal and expected. But most investors try to run away from the hint of volatility, even when running is not possible. Some markets and traders are more volatile than others, but degrees of volatility are basic facts of life. To trend following, volatility is the precursor to profit. If you have no volatility, you have no opportunity for profit. The press is always confused, as seen in Business Week. Trend followers are trying to make sense out of their dismal recent returns. When you look past the superficial question of how we did, you look under the hood and see immense change in the global markets, says John W. Henry's president. Volatility is just a harbinger of new trends to come. Maybe, but futures traders are supposed to make money by exploiting volatility. Performance isn't a superficial question if you are among the thousands of commodity fund customers who lost money when the currency markets went bonkers. Focusing on one period in isolation while ignoring a complete performance history misrepresents the full picture. I wondered if this reporter had written a follow-up article correcting his observations about trend following, because the following year, trend trader Dunn produced a 60.25% return, and trend trader Parker produced a 61.82% return. It didn't surprise me. Business Week archives revealed no correction. Volatility. Hedge fund researcher Nicolas Meaden compared monthly standard deviations, volatility as measured from the mean, and semi-standard deviations, volatility measured on the downside only, and found that although trend following arguably experiences higher volatility, it is often concentrated on the upside, positive returns, not the downside, negative returns. Trend following performance is thus unfairly penalized by performance measures such as the Sharpe ratio. The Sharpe ratio ignores whether volatility is on the plus or minus side because it does not account for the difference between the standard deviation and the semi-standard deviation. The actual formula is identical, with one exception. The semi-standard deviation looks only at observations below the mean. If the semi-standard deviation is lower than the standard deviation, the historical pull-away from the mean has to be on the plus side. If it is higher, the pull-away from the mean is on the minus side. Meaden points out the huge difference that puts trend-following volatility on the upside if you compare monthly standard, 12.51, and semi-standard, 5.79 deviation. Here's another way of thinking about upside volatility. Ponder a market going up. You enter at $100 and the market goes to $150. Then the market drops to $125. Is that necessarily bad? No, because after going from $100 to $150 and then dropping back to $125, the market might then zoom up to $175. This is upside volatility in action. Even Harry Markowitz, see podcast episode number 235, who won the Nobel Prize for his mean variance theory, has noted semi-variance is a better risk measure. He has even said he might not have won that Nobel Prize if he built CAPM around semi-variance. Quite simply, trend following has greater upside volatility and less downside volatility than traditional equity indices because it exits losing trades quickly. Trend trader Graham Capital mitigates the fear. A trend follower achieves positive returns by correctly targeting market direction and minimizing the cost of his portfolio. Thus, while trend following is sometimes referred to as being long volatility, trend followers technically do not trade volatility, although they often benefit from it. The question, then, is not how to reduce volatility, you can't control the market after all, but how to manage it through proper position sizing or money management. You have to get used to riding the bucking bronco. Great trend traders don't see straight-up equity curves in their accounts, so you are in good company when it comes to the up and down nature of making money. John W. Henry sees the distinction. Risk is very different from volatility. A lot of people believe there is no difference, but there's a huge difference, and I can spend an hour on that topic. Suffice it to say that we embrace both volatility and risk, and for us, risk is that we're going to lose if we risk 0.2% on a particular trade. That is, to us, real risk. Giving back a profit to you probably seems like risk. To us, it seems like volatility. Henry's worldview didn't avoid high volatility. The last thing he wanted to experience is volatility that forced him out of a major trend before he could make a profit. Dinesh Desai, a trend follower from the 1980s, was fond of saying he loved volatility. Being on the right side of a volatile market was the reason he retired rich. Even with predictable and ongoing volatility debates, trend following has one of the longest-standing track records in the hedge fund industry and has consistently demonstrated its diversifying power. The ability to take short positions objectively is absolutely crucial, As a strategy with a relatively low Sharpe ratio, it needs to be well understood by investors, so the size of positions is in line with their particular risk tolerance. However, the skeptics and critics always view high volatility as only bad. For example, a fund manager with $1.5 billion in assets remains on the sidelines, refusing to believe in trend following. My biggest source of hesitancy about the asset class, trend following, is its reliance on technical analysis. Trading advisors do seem to profit, but because they rarely incorporate economic data, they simply ride price trends until they reverse. The end result of this crude approach is a subpar return-to-risk ratio. Another money manager opines, "Why should I give money to a Double-A baseball player when I can hire someone in the major leagues?" Looking at the absolute performance of great trend traders and calling it Double-A baseball makes little objective sense. I doubt this guy made it past October 2008 unless he was bailed out. Of course, the funds and banks that all blew out then were all considered major league. But if you can get beyond the volatility is the devil propaganda, it's easy to see how you can benefit from volatility. Trend follower Jason Russell says it well. Volatility matters when you feel it. All the charts, ratios, and advanced math in the world mean nothing when you break down, vomit, or cry due to the volatility in your portfolio. I call this the vomitility threshold. Understanding your threshold is important, for it is at this point that you lose all confidence and throw in the towel. Traders, portfolio managers, and mathematicians seem well equipped to describe risk with a battery of formulas and ratios they use to measure volatility. However, even if you can easily handle the math, it can be a challenge to truly conceptualize it. I can sum it up as follows. Surrender to the reality that volatility exists, or volatility will introduce you to the reality that surrender exists. Building on Russell's point, David Harding was asked, "You've attracted quite a lot of new money into the fund since you've launched, but particularly in the last couple of years. Why?" Harding replied, "The market has bought what actually is quite a complicated story. Our story is not simple. In our early years, we were impeded by the terrific performance of dot-com stocks. Later, people became very attracted to certain types of hedge funds, which produced very smooth and steady returns, something which we've never purported to do. But now that the story has been got across better, people are, I think, realizing that we are a good horse to back in the race." Drawdowns. With trend following, however, comes the inevitable drawdown. A drawdown is any losing period during an investment record. It is defined as the percent retrenchment from an equity peak to an equity valley. A drawdown is in effect from the time an equity retrenchment begins until a new equity high is reached. That is, in terms of time, a drawdown encompasses both the period from equity peak to equity valley, length, and the time from the equity valley to a new equity high, recovery. For example, if you start with $100,000 and drop to $50,000, you are in a 50% drawdown. You could also say you have lost 50%. The drawdown is thus a reduction in your account equity. Yes, that happens for buy and holders too, but the big difference is that trend following has an exit strategy built in. Not surprisingly, many investors and regulators have made drawdown for trend following a dirty word, while leaving mutual funds free to disguise their true drawdowns. Dunn Capital's retort, "Investors should be aware of the volatility inherent to our trading programs. Because the same portfolio risk profile is intrinsic to all programs, investors in any program can be expected to experience volatility similar to our composite record. During 40-plus years of trading, the composite record on a month-to-month basis has experienced 8 serious losses exceeding 25%. The 8th such loss equaled 40%, beginning in September 1999 and extending through September 2000. This loss was recovered in the 3-month period ending in December 2000. The most serious loss in our entire history occurred over a 4-month period, which ended in February 1976 and equaled 52%. Dunn did have a 57% drawdown in 2007, which it recovered from and made new highs as recently as July 2016. Clients should be prepared to endure similar or worse periods in the future. The inability or unwillingness to do so will probably result in serious loss without the opportunity for subsequent recovery. Unless you understand Dunn's philosophy, you might refuse to invest, even though that 40-year-plus track record is the envy of Monday morning quarterbacks. Examine their drawdown history in Figure 3.1 in the included supplemental PDF. I use this same chart in Chapter 2 to illustrate performance, but it serves another purpose. Imagine the valleys between the peaks are filled with water. First, place a piece of paper over the chart, and then slowly move the paper to the right and uncover the chart. Imagine you have made a large investment in the fund. How do you feel as you move the page? How long can you remain underwater? How deep can you dive? Do you pull out the calculator and figure out what you could have earned at the bank? Do you figure out you lost enough to buy a vacation, car, house, or perhaps solve the hunger crisis of a small nation? To the eyes-wide-open player, this drawdown chart, Figure 3.1, is tolerable because of the absolute returns over the long term, but that doesn't make it easy to accept. An accurate discussion of drawdown inevitably leads to the recovery conversation, which means bringing capital back to the point where a drawdown began. Historically, trend following has quickly made money back during recovery from drawdowns. However, you can't neglect the math associated with losing money and making it back. What if you start with $100 and it drops to $50? You are now in a 50% drawdown. How much do you have to make to get back to break even? Table 3.2 in the included PDF. You need 100% to get back. That's right. When you go down 50%, you need to make back 100% to get back to break even. Notice as drawdown increases, see Table 3.2 in the included PDF, the percent gain necessary to recover to the break-even point increases at a much faster rate. Trend-following strategy lives with this chart daily. It handles the math. Table 3.2, Drawdown Recovery Chart. Size of drawdown, 5%. Percent gain to recover, 5.3%. Drawdown, 10%. Recover, 11.1%. Drawdown, 15%. Recover, 17.6%. Drawdown, 20%. Recover, 25%. Drawdown, 25%. Recover, 33.3%. Drawdown, 30%. Recover, 42.9%. Drawdown, 40%. Recover, 66.7%. Drawdown, 50%. Recover, 100%. Drawdown, 60%. Recover, 150%. Drawdown, 70%. Recover, 233%. Drawdown, 80%. Recover, 400%. Drawdown, 90%. Recover, 900%. Size of drawdown, 100%. Percent gain to recover, ruin. David Harding goes after drawdown haters. A key measure of track record quality and strategy riskiness in the managed futures industry is drawdown, which measures the decline in net asset value from the historic high point. Under the Commodity Futures Trading Commission's mandatory disclosure regime, managed futures advisors are obliged to disclose as part of their capsule performance record their worst peak-to-valley drawdown. As a description of an aspect of historical performance, drawdown has one key positive attribute. It refers to a physical reality, and as such, it is less abstract than concepts such as volatility. It represents the amount by which you are less well off than you were, or, put differently, it measures the magnitude of the loss an investor could have incurred by investing with the manager in the past. Managers are obliged to wear their worst historical drawdown like a scarlet letter for the rest of their lives. If the complete story of an absolute return trading strategy is understood, drawdown fear is mitigated. However, you can't eliminate catastrophic risk, much less drawdowns, from trading. A great example of getting scared at the wrong time during a drawdown can be seen in this trader's story. I once opened an account for a client, At the time, we were down 10 to 12%, and I explained the drawdown and our expectation for losses. Suddenly, when his account went down 20%, he became very anxious. He eventually closed his account. He made the business decision to stop trading because of the pain he was feeling from the drawdown. I continued to track his account hypothetically so I could see what would happen if he would have continued trading. He added, "As it turns out, he closed his account within 2 days of the drawdown low. Had he stayed invested, he would be up 121.1% from his closing value and 71.6% from his starting value through October 2008. I am reminded of a statement quoted many times from Peter Lynch, the manager of the Fidelity Magellan Fund. In light of Lynch's trading success, he revealed over 50% of the investors in his fund lost money. He explained the reason. Most investors pulled out at the wrong time. They traded with their gut and treated drawdowns as a cancer rather than the natural ebb and flow of trading. Interestingly, there is another perspective on drawdowns that few consider. When you look at trend-following performance data, for example, Dunn's track record, you can't help but notice certain times look better than others to invest. Some clients do look at that performance chart and buy when the fund is experiencing a drawdown. Because if Dunn is down 30%, and you know from analysis of past performance data that recovery from drawdowns can be quick, then buying while on sale is an option. This is commonly referred to as equity curve trading. Trend trader Tom Basso. I haven't met a trader yet that wouldn't say privately that he would tend to buy his program on a drawdown, particularly systematic traders. But investors seem to not add money when, to traders, it seems to be most logical to do so. Why don't investors invest on drawdowns? I believe the answer to that question lies in the investing psychology of buying a drawdown. The human mind can easily extrapolate 3 months of negative returns into how long at this rate will it take to lose 50% or everything? Rather than seeing the bargain and the positive return to risk, they see only the negative and forecast more of the same into the future. Not only do some trend followers tell clients to buy into their funds during a drawdown, they also buy into their own funds during the drawdowns. I know employees at top trend following funds who are too happy when they are in a drawdown because they can buy their fund cheap. Other trading styles have drawdowns too. For example, some of the best names on Wall Street, non-trend followers, had tough sledding in 2008, but they don't have the drawdown stigma associated with trend following. Warren Buffett, Berkshire Hathaway, negative 43%. Ken Hebner, CMG Focus Fund, negative 56%. Harry Lang, Fidelity Magellan, negative 59%. Bill Miller, Legg Mason Value Trust, negative 50%. Ken Griffin, Citadel, negative 44%. Carl Icahn, Icahn Enterprises, negative 81%. T. Boone Pickens, down $2 billion since July 2008. Kirk Kerkorian, down $693 million on Ford shares alone. It is paramount to determine how quickly you can recover from a drawdown and get back to making new money again, regardless of trading strategy. Correlation. Correlation comparisons help to show trend following as a legitimate style and demonstrate the similarity in strategy used among trend followers. Correlation is not only important in assembling the portfolio you trade, but it is also a critical tool for analyzing and comparing the performance histories of trend followers. In a research paper titled Learning to Love Non-Correlation, correlation is defined as a statistical term giving the strength of linear relationship between two random variables. It is the historical tendency of one thing to move in tandem with another. The correlation coefficient is a number from -1 to +1, with -1 being the perfectly opposite behavior of two investments. For example, up 5% every time the other is down 5%. The +1 reflects identical investment results, up or down the same amount each period. The further away from +1 one gets, and thus closer to -1, the better a diversifier one investment is for the other. But to keep things simple, another description of correlation is instructive: the tendency for one investment to zig while another zags. Let's look at an example. I took the monthly performance numbers of trend followers and computed their correlation coefficients. Comparing correlations gave the evidence that trend followers trade typically the same markets in the same way at the same time. Look at the correlation chart, see Table 3.3a in the supplemental PDF, and ask yourself, why do two trend followers who don't work in the same office, who are on opposite sides of the continent, have the same 3 losing months in a row with similar percentage losses? Then ask, why do they have the same winning month, then the same 2 losing months, and then the same 3 winning months in a row? The relationship is there because they can respond only to what the market offers. The market offers trends to everyone equally. They're all looking at the same market, aiming for the same target of opportunity. Table 3.3b in the supplemental PDF also shows trend followers using similar techniques. Interestingly, correlation can be a touchy subject. The turtles were all grateful to Richard Dennis for his mentoring, but some were ambivalent over time, obviously indebted to Dennis, but struggling to achieve their own identity. One turtle says his system is 95% Dennis's system and the rest his own flair. I'm a long way from someone who follows the system mechanically, but by far, the structure of what I do is based on Richard's systems, and certainly, philosophically, everything I do in terms of trading is based on what I learned from Richard. Even when correlation data shows similar patterns among Dennis's turtle students, the desire to differentiate is stronger than their need to honestly address obvious similarities in their return streams. There no longer is a turtle trading style in my mind. We've all evolved and developed systems that are very different from those we were taught, and that independent evolution suggests that the dissimilarities to trading between turtles are always increasing. A turtle correlation chart paints another picture. The relationship is there to judge. The data, Table 3.4 in the supplemental PDF, is the ultimate arbiter. There is more to the story than correlation, however. Although correlations show turtles trade in a similar way, their returns differ due to their individual leverage and portfolio choices. Some traders use more leverage, others less. Turtle trader Jerry Parker explains, "The bigger the trade, the greater the returns and the greater the drawdowns. It's a double-edged sword." Zero sum. The zero-sum nature of many markets is arguably the most important concept in markets. Larry Harris, chair in finance at the Marshall School of Business at University of Southern California. Trading is a zero-sum game when gains and losses are measured relative to the market average. In a zero-sum game, someone can win only if somebody else loses. Harris told me he was amazed at how many people came from my websites to download his white paper on zero-sum trading. The topic left out of most strategy discussions. It's one winner and one loser. Harris examines the factors that determine who wins and who loses in market transactions. He does this by categorizing traders by type and then evaluating speculative trading styles to determine whether the styles lead to profits or losses. Winning traders can only profit to the extent that other traders are willing to lose. Traders are willing to lose when they obtain external benefits from trading. The most important external benefits are expected returns from holding risky securities that represent deferred consumption. Hedging and gambling provide other external benefits. Markets would not exist without utilitarian traders. Their trading losses fund the winning traders who make prices efficient and provide liquidity. There are those who absolutely do not accept that there must be a loser for them to be a winner. They cannot live with the fact everyone can't be a winner. Although they want to win, many do not want to live with the guilt by their winning, someone else has to lose. This is a poorly thought out yet all too common view of the losing trader's mindset. Harris is clear on what separates winners from losers. On any given transaction, the chances of winning or losing may be near even. In the long run, however, winners profit from trading because they have some persistent advantages that allow them to win slightly more often or occasionally much bigger than losers win. To trade profitably in the long run, you must know your edge. You must know when it exists, and you must focus your trading to exploit it when you can. If you have no edge, You should not trade for profit. If you know you have no edge, but you must trade for other reasons, you should organize your trading to minimize your losses to those who do have an edge. Recognizing your edge is a prerequisite to predicting whether trading will be profitable. Nobel Prize winner and co-founder of famed trend-following incubator Commodities Corporation, Paul Samuelson adds, "For every trader betting on higher prices, another is betting on lower prices. These trades are matched. In the stock market, all investors, buyers and sellers, can profit in a rising market, and all can lose in a falling market. In futures markets, one trader's gain is another's loss." Dennis Gartman adds to the perspective, "In the world of futures speculation, for every long there is an equal and opposite short. That is, unlike the world of equity trading where there needn't be equal numbers of longs versus shorts, in the world of futures dealing there is. Money is neither made nor lost in futures. It is simply moved from one pocket to the next as margins are swapped at the close of trading each day. Thus, every time there is a buyer betting that prices shall rise in the future, there is an equal seller taking the very opposite bet, betting that prices will fall." These observations will save your skin if you are willing to accept the truth. But as you can see throughout this volume, many are either ignorant to zero-sum thinking, choose to ignore it, or refuse to believe it, condemned to exist inside biases. George Soros. The trading success of famed speculator George Soros is well known. In 1992, he was labeled the man who broke the British pound for placing a $10 billion bet against the pound that netted him at least $1 billion in profit. Yet even successful pros sometimes miss a key point. Years back, Soros appeared on Nightline, an old-school ABC news program. This exchange between Soros and then-host Ted Koppel goes to the zero-sum understanding, or lack thereof. Ted Koppel: "As you describe it, the market is, of course, a game in which there are real consequences. When you bet and you win, that's good for you. It's bad for those against whom you have bet. There are always losers in this kind of game." George Soros: "No, see, it's not a zero-sum game. It's very important to realize." Ted Koppel: "Well, it's not zero-sum in terms of investors, but, for example, when you bet against the British pound, that was not good for the British economy." George Soros: "Well, it happened to be quite good for the British economy. It was not, let's say, good for the British Treasury because they were on the other side of the trade. It's not. Your gain is not necessarily somebody else's loss." Ted Koppel: "Because, put it in easily understandable terms, I mean, if you could have profited by destroying Malaysia's currency, would you have shrunk from that?" George Soros: "Not necessarily, because that would have been an unintended consequence of my action. It's not my job as a participant to calculate the consequences. This is what a market is. That's the nature of a market, so I'm a participant in the market." Soros opens a can of worms with his description of zero-sum. From a blog post that incorrectly analyzes Soros's interview, cosmetically, Koppel wipes the floor with Soros. He's able to portray Soros as a person who destroys lives and economies without a second thought, as well as simplify, beyond belief, something that should not be simplified. This is nonsense. The fact Soros is a player in the market does not establish him as a destroyer of lives. You might disagree with Soros's political ideology, but you can't question his morality for participation in markets. You have a 401k plan designed to generate profits from the markets, like Soros. Others, such as Lawrence Parks, a union activist, correctly state that Soros is in a zero-sum game, but Parks then goes jealous by declaring zero-sum unfair and harsh for the working man. Since currency and derivative trading are zero-sum games, every dollar won requires that a dollar was lost. Haven't they realized what a losing proposition this has been? What's more, why do they keep playing at a losing game? The answer is that the losers are all of us, and while neither rich nor stupid, we've been given no choice but to continue to lose. And every time one of these fat currencies cannot be defended, the workers, seniors, and business owners of that country, folks like us, suffer big time. Indeed, as their currencies are devalued, workers' savings and future payments, such as their pensions, denominated in those currencies lose purchasing power. Interest rates increase. Through no fault of their own, working people lose their jobs in addition to their savings. There have been press reports that after a lifetime of working and saving, people in Indonesia are eating bark off the trees and boiling grass soup. While not a secret, it is astonishing to learn how sanguine the beneficiaries have become of their advantage over the rest of us. For example, famed financier George Soros, in his recent The Crisis of Global Capitalism, plainly divulges, "The Bank of England was on the other side of my transactions, and I was taking money out of the pockets of British taxpayers. To me, the results of this wealth transfer are inescapable." Parks says his only choice is to lose. He loses, his union loses. It's a pity party. It seems everyone loses in the zero-sum game, even though Parks' fund will of course have their assets invested in the very funds he criticizes. Look, there are winners and losers, and he knows that. Yes, the zero-sum speculation game is indeed a wealth transfer. The winners profit from the losers. Life is not fair. If you don't like being a loser in the zero-sum game, then it is time to consider how the winners play the game. Trying to understand Soros's reasons for denying zero-sum would be speculation on my part. Soros is not always the zero-sum winner either. He was on the losing side of the zero-sum game during the long-term capital management fiasco in 1998, in which he lost $2 billion. He also had severe trouble in the 2000 technology meltdown. With bets that went sour on technology stocks and on Europe's new currency, the 5 funds run by Soros Fund Management have suffered a 20% decline this year and, at $14.4 billion, are down roughly a third from a peak of $22 billion in August 1998. These wins and losses took a toll on Soros. Maybe I don't understand the market. Maybe the music has stopped, but people are still dancing. I am anxious to reduce my market exposure and be more conservative. We will accept lower returns because we will cut the risk profile. Don't blame zero-sum. Longtime federal judge Milton Polak's ruling that dismissed class action suits illustrates zero-sum confusion. He minces no words in warning whiners about the game they are playing. Seeking to lay the blame for the enormous Internet bubble solely at the feet of a single actor, Merrill Lynch, plaintiffs would have this court conclude that the federal securities laws were meant to underwrite, subsidize, and encourage their rash speculation in joining a freewheeling casino that lured thousands obsessed with the fantasy of Olympian riches, but which delivered such riches to only a scant handful of lucky winners. Those few lucky winners, who are not before the court, now hold the monies that the unlucky plaintiffs have lost, fair and square, and they will never return those monies to plaintiffs. Had plaintiffs themselves won the game instead of losing, they would have owed not a single penny of their winnings to those they left to hold the bag, or to the defendants. A 96-year-old judge bluntly telling plaintiffs to take responsibility for their own actions was no doubt painful for those seeking an incompetence bailout. Polak flatly nails the losers for trying to circumvent the zero-sum market process via the judicial process. The harsh reality of speculation is you only have yourself to blame for decisions you make with your money. You can make ongoing losing or winning decisions. It's your choice. David Drews, a longtime trend follower, takes Judge Polak's ruling a step further, spelling out the practical effects. Everyone who enters the market thinks they will win, but obviously there are losers as well. Somebody has to be losing to you if you are winning. So we always like to stress that you should know from whom you're going to take profits, because if you're buying, the guy that's selling thinks he's going to be right too. The market is a brutal place. Forget trying to be liked. Need a friend? Get a dog. The market doesn't know you and never will. If you are going to win, someone else has to lose. If you don't like these survival of the fittest rules, then stay out of the zero-sum game. Berkshire Hathaway. Amidst the recent celebration of Berkshire Hathaway's 50 years of investment returns, trend-following trader Bernard Drury and his firm Drury Capital wondered if a portfolio holding Berkshire, BRKA, already hugely successful, could nonetheless be improved by combining holdings of BRKA with other assets. An ideal candidate for investment alongside BRKA would be an asset with both positive returns on a standalone basis as well as low correlation to BRKA. In 1983, Dr. John Linter published the classic paper, The Potential Role of Managed Commodity Financial Futures Accounts and/or Funds in Portfolios of Stocks and Bonds. In this study, he pointed to gains in risk-adjusted rates of return that potentially could be obtained by combining equity investment with managed futures. To examine a portfolio combination of stocks and managed futures, read Trend Following, Drury focused on Berkshire because of its legendary performance. On the managed futures side, Drury's Trend Following Fund satisfies the requirements of having both strong performance and almost zero correlation to Berkshire. While Drury cannot cite the same longevity as Berkshire, it has been in continuous operation for almost 19 years. At least for these years, it is useful to examine Drury in relation to Berkshire for a possible improvement of overall portfolio returns. The two performance records, taken individually during this period, are broadly similar. Table 3.5, May 1997 to February 2015. Drury and BRKA. Rate of return. Drury, 11.3%, BRKA, 10.4%. 50% Drury, 50% BRKA, 10.9%. Standard deviation. Drury, 20%, BRKA, 20.6%. 50% Drury, 50% BRKA, 14.4%. Drawdown. Drury, 32.5%, BRKA, 44.5%. 50% Drury, 50% BRKA, 23.9%. Rate of return divided by drawdown. Drury, 0.35, BRKA, 0.23. 50% Drury, 50% BRKA, 0.5. Rate of return divided by volume. Drury, 0.57, BRKA, 0.5. 50% Drury, 50% BRKA, 0.83. The correlation between the two return streams is 0.01. Despite the overall similarity of returns, the paths to producing these returns have nothing in common. Consequently, as modern portfolio theory would predict, the performance of a portfolio holding Berkshire is potentially improved by adding a non-correlated Drury. It is, of course, equally true a portfolio holding only Drury is potentially improved by being coupled with a non-correlated asset such as Berkshire. A look at the efficient frontier for this two-asset portfolio suggests a blend of approximately 50-50 would have produced the highest ratio of rate of return versus standard deviation of returns. The portfolio with 50% each in Berkshire and Drury raised the risk-adjusted rate of return to a level higher than either could achieve individually. For the holder of Berkshire, the diversification reduced the portfolio volatility by almost one-third and reduced the depth of the peak-to-trough drawdown by almost half. Finally, and perhaps even remarkably, the combination of Berkshire holdings with this non-correlated asset cut the length of the drawdown associated with holding Berkshire alone by a whopping 43 months. This means instead of experiencing a 61-month period, December 2007 to January 2013 underwater, relative to the latest high price, while holding Berkshire shares alone, the combined portfolio reduced the underwater period to only 18 months. By the same token, of course, the underwater period of holding Drury alone is reduced from 55 months to the same 18 months. Table 3.6, May 1997 to February 2015 drawdown, December 2007 to January 2013. Drawdown, Drury, 32.5%. BRKA, 44.5%. 50% Drury, 50% BRKA, 23.9%. Peak to trough, months, Drury, 32, BRKA, 14. 50% Drury, 50% BRKA, 10. Trough to peak, months, Drury, 23, BRKA, 47. 50% Drury, 50% BRKA, 8. Total, months, Drury, 55, BRKA, 61. 50% Drury, 50% BRKA, 18. Columbia University professor Benjamin Graham led academia and Wall Street with pioneering work across value investing. Famously, Warren Buffett was one of his students in the 1940s, and years later, the Nobel Prize-winning work of Harry Markowitz explored the effects of combining non-correlated assets to improve risk-adjusted returns. Markowitz is credited with the often repeated quip that diversification is the only free lunch in finance. Thus, it's not surprising that adding Drury's trend following as diversification to Buffett and Berkshire clearly enhances an overall portfolio return while reducing volatility. Ultimately, performance data is the driver, the only truth we can take in for analysis. If there is no data, no believable narrative can be used to explain anything. And trend-following data is a very clever way to illustrate human behavior with numbers, and it happens to also be proof of concept any skeptic would want before jumping into the deep end to deploy their risk capital. Yet where does trend-following performance data come from exactly? Summary food for thought. FU money. If you trade for absolute returns, you have the chance for FU money, the money it would take to leave your job and never work again. Ewan Kirk. When people ask, "What do you think is going to happen in the future?" we always say, "We don't know." We can't really project whether next year will be a good year or a bad year. Absolute return means trying to make the most possible. In a zero-sum game, the total gains of the winners are exactly equal to the total losses of the losers. George Crapple. So while it may be a zero-sum game, a lot of people don't care. It's not that they're stupid. It's not speculative frenzy. They're just using the markets for a completely different purpose, hedging. The U.S. Army War College introduced the acronym VUCA to describe general conditions post-Cold War: volatile, uncertain, complex, and ambiguous. Mark Rezepsinski. If a manager cannot explain what he does and his edge in 45 minutes, you should not invest. Bernard Drury graciously contributed for this section. Percentage change in stock price month over month as of each month end across the period covered. BRKA stock prices from Yahoo Finance. Note: you can review trend-following performance going back decades. Send an email for online sources, www.trendfollowing.com/contact.